Portfolio Builder members, welcome to our Tuesday webinar. I'll throw a quick shout out to some of the familiar names. People keep piling in. We'll jump into a presentation and then I'll unmute everybody's mic so we can chat and get to know each other and see how everybody's doing. So we've got some regulars in there. We got Henry, Jerry. I think we've got a new member, Chris, who's actually joining our team. Fred, welcome. Got some free trials. D. Hillstrom, S. Blair, Scott B., Joel Thomas, R.M. Phillips. There's more in there. So welcome, everybody. Thanks for taking time out of your day to join our live webinar. There will be a recording and replay sent out afterwards. So everything was going very merry in our portfolios. And then good old Donald Trump surprised the world with some tweets Sunday. And boy, was I up early Monday morning trying to see how this would all impact the markets. And of course, the SPY is just so strong, we had to have basically a conflicting view. We get a drop in the futures market on Sunday, and then of course the market just rebounds very strong for all of Monday. And this was on reports that China was still going to show up for the trade talks, and by the end of the day, we had more confirmations that the tariffs will go up on Friday, which caused another drop today. And now we're kind of hovering right here in this 288, 290 range. So let's take a quick look at what's going on in our portfolios. Here's just an interesting chart from Zero Hedge article, just kind of showing the market's reactions to the various headlines. And so the intellectual property is the big sticking point that was suddenly reneged from the talks. And so we don't want our technology being stolen, ripped off, and then just replicated in China. So this is going to be a big deal, and we'll see if they can make resolution this week. Some other charts I wanted to pull up really quick. Sorry about the quick delay there. The U.S. job market continues to get stronger and stronger. There's now a record level of job openings compared to people looking for jobs. And so we have a few charts that illustrates this out today. Other things going around the world, the lira is crashing in Turkey. Cryptocurrencies are spiking now up to 6,000. I do hope to have our software updated for the cryptocurrency portfolio. That portfolio is up huge this year, which is a buy and hold portfolio. But the impact for China in this deal is a lot worse for them than the US. We have the stronger hand right now. So I do think this will work itself out, and that's why we haven't become extremely defensive in our portfolio just yet. Now, we'll talk about that in a minute, but and we continue to have a divergence in the 10-year yield relative to the stock market, which, as many of you know, I've been expecting the yield rate to go up slightly and stocks to go down slightly to get back into the normal tandem that they typically have. If we look at the option chain, this is one of the best ways to predict short-term moves in the SPY and the market in general. And we can see that there's been a lot of trading volume piling in today. And for the first time, we have more open interest sitting on the put option side than we do in the call option side. And just a quick review, when we write a call option, we're agreeing to sell our shares at a certain price. but when we write a put option, we're agreeing to buy the shares at a certain price. And so what I'm most interested in is where the open interest is piling up with the volume in the same day. And so we can see the open interest is piling up right at the 289 strike and not far below. So there's not a lot of hedging going on in the big players where they're trying to predict a big down move today, at least. And if we come over here to 3 days out, we can see the call option volume and open interest has become very light. And this was not the case all year. And the market is very momentum orientated. And so we can see a similar setup here. We do have a lot of open interest and volume at this 288 strike, but there's nothing really pounding much lower into the money in the strikes. So we're remaining somewhat neutral on the covered call in the basic program, but we did add a hedge. So let's take a look at that. Okay, so our profits from Friday dropped from around 39,000 to 31,000. And we've continued to write covered calls that were out of the money, which means we can collect the cash from the covered call plus enjoy an increase in value on the underlying asset. So we did that, but we sold our TBT position, which is a bet on rates rising, which I still think will happen, but I want to wait until the coast is clear. If the tariff war does escalate, I would expect rates to be lowered. But if this does de-escalate, then I would expect rates to start to creep up along with stocks. So we moved to an inverse ETF position of 5% in the basic portfolio. And these are these inverse ETFs right here. This is a 3 times leveraged bear tech and bear bank. So we're up slightly on that. It has helped offset the volatility over the last overnight. And our covered call will most likely generate a 100% or a 98% profit come tomorrow because it has traded down quite substantially during this period. And the reason we're doing that out of the money covered call is because when there is a sudden jump up like we had yesterday, we don't want to miss out on a big run up in the underlying asset. So collecting the 42 cents there and just hanging on to the SPY with a little bit of volatility right now. And things may change. We have to see how this plays out by Friday. So if things do seem to get nastier, the quick change that we will implement tomorrow in this portfolio will be to increase the exposure to the inverse ETFs, which we will gradually do every Monday, Wednesday, Friday as things potentially escalate. And then we'll start moving the covered call from above the trading price, which is an out of the money covered call, and we'll start doing the in the money covered call. So I'll go into this in more detail in a second here, but that's the plan right now. We're being patient. The market's still not betting down. We have the strongest economy by far, and so I think we do have the negotiation power on our side. But I also think back to just how stubborn Trump was. I look at the government shutdown in December, and that sort of mentality is what scares me and what would make me start playing a lot safer. And so I'll flip back to our basic portfolio in a moment to go over how we would go into a very defensive strategy that's predicting downturn in the market. And but first, let's look at our diamond program. Now, as a bonus in our diamond program, you do get a buy and hold portfolio that takes advantage of emerging markets. And we can see this portfolio has been hit much harder than anything else. So China's stock market is getting crushed right now during this negotiation process. But if everything is alleviated, then I think there's a lot of growth to be found in this portfolio with a simple buy and hold. So this one dropped from about 5% to 2.7, almost a 50% drop in our profit margin on this portfolio, whereas the other portfolios have had very little drawdown. We lost about 1.3% of our profit on the basic program. And now this is actually inflated. If you watch today's trade alert in the diamond, we wrote very defensive in the money covered calls in this portfolio today. And so because we've realized the credit, but we haven't realized having to buy back that position or sell the strike, that this will go back down. Now, before I had taken those trades on, I can show you what our profit was sitting at just by deleting these really quick. So this had been sitting on a 13% profit in the first, what is it now, about 5 months. And it dropped to 10.9, so it's not too bad. We lost 2 percentage points. What was lucky, this program only trades on Tuesdays, so it is going to play everything a little safer. And so it actually had the defensive covered calls, not just last week, but I've been putting on the defensive positions on this portfolio almost all year. And that's because I was expecting, again, this huge run in the bond market to take some profits, which would cause the rates to rise, and then probably a pullback in stocks. And so people like Ray Dalio may have missed their opportunity to take some of these big profits on at least the stock portion. We'll see how this all plays out. But this portfolio has done extremely well, and it's done it with only trading on Tuesdays. And what it does is it looks at the SPY ETF and it says, what does the SPY ETF actually purchase? And if you go look at what's under the hood, these are the core positions. Now we've stripped out Amazon, Google, and Berkshire, but you get plenty of exposure to that just by buying the SPY. These are the stocks that almost all of our clientele can afford to purchase at least 100 shares of. And so with these ratios where you have 300 of Microsoft, 100 of Apple, Facebook, Intel, Cisco, 200 on Comcast, 900 and 500 of Bank of America and Wells Fargo, this mimics the exact composition of what you would own if you purchased a mixture of the SPY ETF and the QQQ ETF. Now, why is that important? Well, the SPY ETF has $16 billion a day of trading volume. And if you were to add up the trading volume of all of these companies combined, it would barely be more than the SPY. So it turns out that most of the money flows are taking advantage of these ETFs to automate a lot of the work in purchasing these securities. So the biggest buyer of these securities is actually the SPY ETF and the QQQ ETF and a whole bunch of other ripoffs of those exact same ETFs. So why does that give us an advantage in our portfolio? Well, number one, these are the companies that are getting the most funds automatically from ETFs. So that's number one. Number two, these are the companies that are the most profitable. That's why they are the top spots in the SPY. So that's number two. That profit that they're generating is all going to corporate buybacks. So it's no wonder that these stocks are greatly outperforming the general market. And Apple is remarkably strong during this volatility, even though they have a huge exposure risk to China. And it's simply because they have so much money and they just announced that they're going to be buying back their shares. So all of these companies are just now getting through reporting, and I'm expecting the corporations to continue buying stocks over the next several months. So these are some of the reasons why I haven't gotten super defensive and negative in terms of how we're trading our SPY program. Now in this program, we by design are only touching the portfolio on Tuesdays. So to do that, we just have to play it safe. And despite playing it safe in a raging bull market, this portfolio has performed twice as well as a SPY. So it's doing its job. I think everyone can understand why it's doing it so well. And another big advantage is that we can look at the option market data and choose strikes that are either above or below the trading price per security. And if you've been watching our content, the market's been very good. The option market's been very good at predicting which of these stocks will go up week to week. So we've been able to aim the strike price to do so. Now, I've been playing it safe on the biggest positions, Microsoft and Apple, and it has not rewarded us as well as we could have all year until this week. So this is the first week where the Debbie Downer, the negative Nancy, whatever you want to call it, the paranoid trader instincts finally paid off. And it wasn't because of profit taking or anything of that nature. It was simply because of a little tweet from our president. So let's take a look at some of the trades we did today. So at this point, this portfolio has not put on any risky hedges, which I would consider either a call option on the VIX, a put option on either any of these securities directly, or just like a blanket put option on something like the SPY or the QQQ. And I call those risky hedges because if you're wrong, you can lose 100% of that hedge very quickly. So what did we do instead? Well, if you look at this, you can see that we wrote strike prices, and let me put those back in. We wrote strikes that were considerably lower than the trading price. And so this puts us in a situation where if we're wrong and the stock market does rally higher, we're going to make somewhere around 0.5% to 1% per security total return. So if the stocks go up, we get assigned, they exercise their right, they're going to be able to buy this at a discount, we keep their option premium. So in this scenario, we have a no risk setup to predict a down move in stocks. And if we do get a down move, we're protected for quite a move. On Microsoft, it can go as low as 115 before we would see a penny of losses. On Apple, it could go to 180 before we would see a penny of losses. Facebook, 177. So we have a huge cushion. Now, if it trades anywhere between, anywhere above these strike prices, we're generating profits from the call option losing its time value. So the intrinsic value, we don't necessarily generate a profit from. So as the stock goes down, the call option loses intrinsic value. And so that will be a 1-to-1 ratio. So we're not going to generate this much profit from these trades. But once again, it's the time premium that the gambler is losing on when he's wrong. And that's how we end up making profits 99% of the time with both of these strategies. So because this program's only trading on the Tuesdays, we have to play it safe. We're not going to be sending out an emergency alert telling you to go hustle and do this or that. Again, these products are designed to let you sleep at night and only work as little as often. And that typically does generate better profits than someone who sits there and over trades. So that's a little look at how we've set up our trades for this program. We're in a situation where we don't have to worry about anything. If the trade resolution is resolved, then I would expect these will all get assigned. We will get to keep the option premium, a little bit of profit, and be back into cash come next Tuesday. But if the market, if the trade war does escalate, most likely we'll be generating a nice profit between now and next Tuesday when we roll over our diamond positions. So come Friday, if things are dramatically escalating, in the diamond program, we will look at some more advanced strategies for shorting the market, and that would involve buying put options most likely on the QQQ. So that would be a very easy trade to jump into and catch a relatively large crash on top of the in-the-money covered calls. Now, on this portfolio, in our basic portfolio, we're not going to mess around with buying any long options. So we're only writing options in this portfolio. And that's typically how smart investors protect assets and generate consistent returns. So at this point, we added the hedge with the ETFs. These are a lot easier to manage than something like a call option or a put option. So they do have very similar reactions to the market movements in terms of gaining or losing value. But with the ETF, it's a lot easier. You can sell off your shares a lot easier. You can adjust it a lot easier. And you don't need to be some sort of options pro. So right now, we only have a 5% hedge, and we're writing the out of the money covered call, expecting the market to recover at this point in time. Now, come Wednesday, we may start to get a little more defensive unless we start to see some relief in the markets. Okay, so that's a good general overview of what we've got going on in our portfolios. Let's see what questions we have so far. Okay, one person wrote, I guess this is a great time to start. Yeah, well, perhaps we're getting it at a good discount. But either way, our strategy, we can protect our assets and generate the profit from the call option losing its value over time. So we don't necessarily need the market to go a certain direction for this strategy to work. But if the market goes up, that's good for the speculator and it's good for us. If the market goes up higher, if the trade resolution is resolved come Friday, I would expect the stock market to start screaming a lot higher. And that's where we can actually get the double paydays. Instead of trying to just pull around 1 to 2% a month profit, we can get more like double that, because now our underlying asset is appreciating and our out of the money covered call is still generating a great return every Monday, Wednesday, Friday. Okay, let's see what other questions we have. Okay, Fred says, I know you have addressed this issue, but I need clarification. If I bought the SPY Monday at 291.48, sold the 294 for 42 cents, closed both for 17 net through Robin, would this have been an okay trade? So yeah, Fred, so this is a situation where certainly, we are experiencing some downside in our portfolio. Now, I do want to point out, if the SPY ETF drops a certain amount, most likely any other stocks you're holding specifically have dropped considerably more. So that's number one. Number two, the covered call helps protect our position. Going into the trades last week, we were very bullish. There was nothing impeding our way to breaking into new highs. Rates are low. Treasury bond yields are so low, it makes no sense to put money into that unless you're just betting on a quick flip, which a lot of people are. And it wasn't until Sunday that the fundamentals changed. Now the fundamentals have changed, and there is a real market risk ahead of us. So it's not hard for us to quickly adjust. And so as we get more clarity this week, you'll see we can switch from writing the out of the money covered call and into the in the money covered call. So let me just pull up an option chain so we can go over kind of the fundamental difference in those and why it makes for such a powerful strategy to protect our assets. So now you can see the option premium for us has skyrocketed, where just from a week or two ago, in order for us to get anywhere near these sort of prices on writing the covered call, this is almost doubled. I mean, this was around $1.25 last week at the money covered call with 2 days. Now we can get $1.70 for only a 1 day covered call, which is pretty phenomenal. So as the volatility increases, the cost to buy call options and put options dramatically increases relative to how far they are from the strike. And so all that means is our strategy for writing covered calls gets much more profitable as volatility rises. And so while we may have some short-term surprises that can catch us off guard, we can react quickly and make up those losses very fast by just doing the same thing, writing the covered call over and over and over again. So right now, market's still telling me up. We can see the volumes betting. All the open interest is settling above the current trading price in both the put option market and the call option market. So I haven't gotten to the point where we're writing the in-the-money covered call on the SPY just yet. Now on the Diamond program, we're only trading once a week, so you better bet your bridges we're going to play it safe in that one. With the SPY program, we've seen just how resilient the SPY is. The job market's increasing, the GDP's at 3.2. The only hiccup we have now is this deal with China. So I've still remained relatively neutral and writing that out of the money covered call. And the reason we want to write the out of the money covered call right now is because if the SPY jumps up $3, $4, $5 in a day or two because Trump says, oh, just kidding, we're not going to raise tariffs, just want to put a little pressure on him, we don't want to miss out on all that upside. So at this point, everything all the data is pointing to just be patient, ride out the volatility, keep the covered call nice and out of the money, lets us enjoy the profits on the underlying asset, plus capture all of the covered call premium. And then the ace up our sleeve are these two inverse ETFs, which are helping reduce the volatility right now. And you can see I've been very hesitant. I'd spent a lot of time deciding whether we would go 5 or 10. And sure, perhaps it should have been 10 yesterday. We probably have no losses right now. But on the other hand, if this had been resolved quicker and if the market had continued rallying like it did yesterday, the potential to lose money on the inverse ETFs is much greater than the potential to lose money on the S&P 500 when you're sitting on record jobs growth, 3.2 GDP, and no competition in the bond market. There's no competition really in the world for where to invest your money right now outside of the S&P 500. So that's why we're seeing it remain so strong and resilient right now. Okay, let me see what some of these questions are. Okay, having sold a covered call on Apple deep in the money, is it likely to get assigned given that the option expiration is on May 10th? Yes, that is the plan. We want to have a no risk situation. So first of all, our strategy is a lot like being a bank. And if you're a bank, you really need to maximize profit margins. And so one way to do that is through your brokerage account. Now, we've got folks on here trading close to $1 million, and they've negotiated very, very good rates with TD Ameritrade, Interactive Brokers, but a few others that are smaller gigs that I like and have personally used with our own personal money. Tradier is a good discount broker for 401k, and Robinhood, if you are doing a cash account, is absolutely free. They're the fastest growing brokerage in the world. They're valued at $5 billion, and private equity in San Fran is paying for everything: stock costs, assignment costs, every last little thing. So when we're in the business of owning securities and loaning them to stock speculators, we do want to maximize our profits and not give it up in commission costs. So the plan with this is, if everything goes great, good for the speculators, okay? People who want to bet that this trade deal is going to be resolved this week and buy a call option, good for them. We love it because they are paying us to have insurance on our securities. So we have quite a bit of security or insurance on all of these positions this week. So if we're wrong, market flies up, all of these are in a situation where we do generate a small profit. And that profit's a little different on each different security, but you can see that the strike difference from the current price when we wrote it is less than the option premium collected. So if the market jumps higher, they're going to make a good profit on their call option. We're going to make a small profit. But what if things just trade flat or slightly down from here? Well, the value of their call option will lose intrinsic value relative to how far the stock goes down. We don't really profit from that, but it does protect our asset. Where we do profit is the time premium that's built into the option contract. So most of the time premium evaporates in the first half of that period. So that's why we cover it next Tuesday and roll it over to the following Friday. So right in the middle. And so yeah, if we get assigned, no big deal. If it goes flat or down, we're making even better profits. Okay, I have a question. If all goes well, will we keep this? So no, we won't keep this. If we did do this, you'd see we'd be making about 10% a week. So we're not trying to make 10% a week in this portfolio. In this portfolio, we're happy to make around 2 to 4% a month total, which equates to around 0.5 to 1% a week. And so our goal is to put ourselves in a situation where a gambler, a stock speculator, doesn't want to put up the capital to buy these securities. And so they just want to buy the call option. And when we're bullish on the market, we can write that call option above the strike price and earn double paydays. And when we get double paydays, this portfolio can go up a lot faster than 2% a month. But when we're playing it safe, then we can easily pull in that 1 to 2% a month as a target. And so right now, when we have a very clear threat to the market sitting right in front of our face, it just makes sense to play it safe. And so all of these went about as deep into the money as you could and still have a no risk situation in terms of if we're wrong, market flies higher, we don't lose. Market goes flat, down slightly, we're going to make about the same in all situations. We're generating the time premium profit. Now, whereas in this portfolio, because we are willing to trade 3 times a week, we have the riskier hedge built in right now with the ETFs. This one I'm willing to do a little different. You can see we have the protection with these two, and we're setting ourselves up for a rebound in the SPY in the next few days. So if we do have a rebound in the SPY, we get to keep all of that appreciation in the SPY, plus we're going to keep all of the covered call income. So until things deteriorate even further, I plan to do a similar trade on Wednesday. All right, let's see what other, let me open it up.
Dead.
We're up to 20 members again in the webinar, and I'm unmuting everybody so we can all say hi. Got a lot of new folks in here and some old. And you can always mute your mic if you don't want to be heard. How's it going, Henry? You out there?
Good. How are you today?
Doing good. Finally, a little volatility in the market. I was wondering if it would ever happen.
I thought we would do an emergency trade this morning.
Yeah, well, you've been ready to do the emergency trade last weekend, this week too, huh? We let me see where that noise is coming from. Okay, there we go. Yeah, we're getting quite a sell-off today. We'll see how we're looking tomorrow. I'm going to be very, very hesitant to throw out trades on Tuesdays or Thursdays, so that people don't feel like this is a program where we're going to be whipsawing you around.
Mhm.
But yeah, I mean, we're getting to the point where we need to see the option market prediction pulling off here by the end of the day. Otherwise, we'll definitely start playing a little safer on the covered call tomorrow.
Gotcha. And here's a suggestion on our. I've been traveling for the last several weeks, so when we get the text, it you know we talked about trying to make the trades even quicker. When we get the text, if you just send us a text, basically buy the cover, buy the close, our last covered call, and then just sell the open.
Sure, yeah, just write out the trade in the text message. That's a great idea. We'll do that tomorrow.
Versus going to the webinar or the video and then having to pull that all out. See what I'm saying?
Yeah, that'd be very easy to do. So what I'll do is I'll send out a text with the strike and expiration first, and then we'll send out the video in a second. Does that sound like a good plan?
That'd be great for me because like I said, I've been traveling and I can just send and just put the trade right in and then watch the video a little bit later or something.
Well, I don't know. Plywood doors, kind of a
Yeah, you don't realize
conversation.
how stuck you are.
That's, right now, there's no door there. There's just.
Oh, we got too much audio. Okay, here, I'm gonna mute it all down, and if you have a question, go ahead, and if you'd like to unmute your thing, you can raise your hand. Joel, I see your hand's raised. Do you have a question? I unmuted you so you can talk. I guess he's okay. Let's see what other. Go ahead and type in your questions, guys. Sorry, we have such a big audience, it gets a little loud. So yeah, I mean, right now, nobody likes to see an unrealized loss in their underlying asset. So yeah, you got to ask yourself, why do I continue to write that covered call in a bullish stance right now? And the reason why is because I do think that we have the upper hand in these negotiations. The job market's continuing to get hotter and hotter. GDP is well above all expectations. The profit earnings from the corporations were stronger than expected. So my fear is that if we were to start writing the in-the-money covered call on the SPY, we're going to miss out on $3, $4, $5, $6 of upside move in our underlying asset in a very short time period. And that time period will probably be very hard to predict when exactly it's going to occur. And so that's the biggest mistake you can make when you get too defensive too quickly with every little move down. Now, so those are the reasons, why I'm continuing to write the covered call above the trading price. Now, if tariffs become a fact and not just a threat, then certainly we will get much more defensive and be writing the in-the-money covered call. But I just don't want us to miss out on $3, $4, $5 of profit in a single day times 100 shares times how many ever contracts you're doing. So that's why I am holding on to the volatility, and that's why this business works. If there were no volatility in the SPY, we wouldn't be able to pull these types of covered call premiums 3 times a week. So that is the inherent risk. And because we're long term, we don't mind small amounts of volatility. So if I were to start doing the covered call too defensively too early, before the threat of the tariffs really starting to deteriorate our economic data was actually a fact and not just a potential rumor, we may miss out on a huge run up in our underlying asset that's been sparked by a tweet. All the economic data is really strong right now. So there's no competition in the bond market in the US. If you go around the world, good grief, the bond markets are near 0%. So bond market's not competing for our money. What is? Real estate's not. China's at the mercy of this tariff war. The rest of the world's at the mercy of China's health. So in my opinion, I think that as soon as this is resolved, the SPY is going to fly much higher. And so I don't want us to kind of shorten out our profits by getting too scared too early. So that's kind of the bottom line with why we're remaining positive on this right now. And you know, we haven't lost a lot. Let's just take a look. You know, we lost a 1.5 points. And this is not a very typical, not a typical move. So, okay, let's see what other questions we got out there, guys. All right, well, that wraps up another great webinar. I want to appreciate everybody who joined us today. We'll be keeping a strong look at what's coming in on the tariff war and also the market. And if tomorrow the market's still trading down, we may get a little, what we'll probably do is increase our exposure to TECS and FAS and start bringing that covered call strike price down. But I'm very hesitant to do that because everything is pointing that this should rebound, and we don't want to miss out on a $3, $4, $5 of increase in the SPY just to get back to our old level, which is up at that 293, 295 range, which I do think we can break through if there is a resolution. And I think China really needs a resolution. Their stock market has been getting hammered about 3 times as bad as the American market. So we'll just have to see how this plays out. And even though it did cause us a little bit of a pullback in our total return, the big news for us, and I'll show you guys, let's just take a look. If we go back in time to last week, so we're looking at, let's go to last week on Wednesday, okay? And we'll look at the expiration on Friday. So you can see we can write a in the money covered call for about $1.18. So we start to go a little higher, 94.71. Okay, now let's see what we can get paid for a similar amount of time. And let's try to make this a little more accurate. So that was, because I'm gonna have to do a time comparison for a 3-day hold. So if we had written a covered call last Tuesday, expiring on the 3rd, which is a Friday, so that's a 3-day hold, we could get between $1.40 right at the money or $1.10. Okay, now let's look at real time. So now the same trade, what do you notice? These option premiums are almost triple. So yeah, it sucks to see your underlying asset drop a little bit, but in the business of selling call options, which is what we're in the business of doing with this strategy, it's great news. This is really good news. Now our option premium is literally triple, almost triple what it was just a week ago. So we can write that out of the money covered call, get 2 to 3 times what we normally would have, and still get the increase in the underlying asset if this trade war is resolved. Now, if it escalates, sure, we're going to switch gears. We're going to be writing the in the money covered call, and we'll still make that same boring return, but it's closer to 1 to 2% return per month if we're playing it safe. If we're playing it a little aggressive and writing the out of the money covered call and the market's going higher, we can generate somewhere around 2 to 3% a month. So that makes a big difference over the course of a year. Any last questions out there? All right, guys. Well, I really appreciate your time. We do have another webinar Thursday, same time, same place. This replay will go out shortly after we get it all downloaded and encoded. Tomorrow at noon Eastern, we have a new trade alert. My expectation is to continue writing the out of the money covered call where we get the double payday. And but we'll see what Wall Street's telling us tomorrow morning with the option data, and we'll go from there. So thanks again for all your time, and looking forward to sending you a new trade alert tomorrow.